Here are my thoughts about the 2021 stock market crash. The stock market is not crashing yet. If you have been on the internet in the past couple of days, you'll see countless articles, news, and even videos on YouTube talking about the impending stock market crash. And as an audience, you need to know this fact. In order to get attention and eyeballs, these articles, news, and YouTube videos need to sensationalize their headlines. Topics and headlines such as stock market crashes tend to get the most attention and eyeballs because they prey on fear. However, if you calm down and look past these sensationalized headlines, you'll see that the stock market is actually not crashing yet. So in this video, I'll not be only stating that the stock market is not crashing, but I'll actually show you numbers and figures to back up my claim that the stock market is not crashing just yet. The very first things that we need to take a look are the definition for a correction and a crash. And we need to know the difference between a stock market correction versus a stock market crash. A stock market correction or stock market retracement is anything less than a 20% decline in stock prices. As long as the prices for the stock market declines less than 20%, we classify these declines as corrections and retracements. And for a bear market or a crash, when the stock market declines by more than 20%, we then classify it as a bear market or a stock market crash. I didn't actually make up this definition. You can actually find these definitions on the internet. If you do a quick Google search on bear market definition, Investopedia defines bear markets as when a market experiences prolonged price declines, and it typically describes a condition in which security prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. And if we take a look at the definition for a stock market crash, a stock market crash is defined as a sudden dramatic decline of stock prices across a major cross-section of a stock market, resulting in a significant loss of paper wealth. And although there's no numerically specific definition of a stock market crash, but the term commonly applies to a decline of over 10% in a stock market index over a period of several days. Those are the definition of a stock market crash and a bear market. And you'll see later on the price chart for the S&P 500 why the price decline we are experiencing right now is not a stock market crash, but instead it is a normal stock market correction and stock market retracement. Right now, the important point for you to take note is the definition between a stock market correction versus a stock market crash. Once you are able to fully grasp these differences, you'll see why this price decline is nothing more than a normal stock market correction. Okay, what you're taking a look at right now is the price chart for the S&P 500. In the past week or so, we see prices for the S&P 500 declining over here. And if we measure the price decline from peak to trough, here's the peak, and then here was the trough for prices. We see prices only declining by around 5 to 6%. This decline in prices for the stock market does not seem as sensationalized as the headlines put it. Yes, a 5 to 6% decline in the stock market is something to pay attention to. However, it's not like a stock market crash that many make it seem to be. To give you some perspective and context, these are the stock market corrections and bear markets in the S&P 500 in the past 70 years, going back all the way to 1950. The blue ones are the corrections and the red ones are the bear markets. Let's put aside bear markets for now. So bear markets are defined as decline of more than 20%. We'll focus on the stock market corrections in this video. If we add up the total decline in stock market corrections that happened in the stock market in the past 70 years and dividing it by the number of stock market corrections that happened, we see that the average decline in prices for the stock market in a stock market correction is around 14.25%. So 14.25% is the decline in an average stock market correction in the past 70 years. And you'll see that based on history, the 5 to 6% price decline in the stock market that we are experiencing right now has not even reached the levels of an average stock market correction in the past 70 years. For the decline in prices that we are experiencing right now in the stock market, it doesn't even match up to the average stock market correction, much less a stock market crash or a bear market. If we go back to the charts for the S&P 500, we see that on Friday, prices managed to make some headway to the upside. But let's say Friday's bullish momentum is temporary. Then the next level that I'm taking a look at is this price level over here. So prices will decline to around this level over here, to where this trend line is. Based on the technicals, prices have about 2 to 3% more to decline until it reaches the trend line. And that is where I believe prices will encounter strong support. Because if we zoom out over here, this trend line has held up quite well in the past. So this was the first point, the second point, the third point, and the fourth point. So if the US stock market continues its decline, the level of support that I'll be taking a look at for the S&P 500 is around this price level of around 367. And even if prices continue to fall to this price level, the peak to trough decline is still around 8%, which still falls short of the average stock market correction that we have seen in the US stock market in the past 70 years. The average being around 14 to 15%. But what if the stock market declines more than 7 to 8% and even fall below the trend line? What happens then? What should we do? Then this is a great opportunity for you to average down on your high conviction stocks. This is an advice for investors, not for traders. As an investor, when the stock market declines, it gives you a great opportunity to add even more shares of your favorite companies at a discount. But only if you have high conviction in these companies and these companies have strong fundamentals and good long-term potential. If you are investing in crappy companies, then averaging down on them is a bad idea because the stock price of these companies can go all the way down and don't recover at all. In fact, if you take a look at these statistics, averaging down in a market decline can be good because according to this data, the average 12-month return after a steep market decline is 55%. And this data is compiled all the way back from 1929. Say the US stock market continues to decline beyond the 5 to 6% that we are currently seeing right now, and also beyond the 7 to 8% decline that I shared in my technical analysis for the S&P 500 earlier on, and the market declines of at least 15% or more, then this would be a good time for you to average down on your high conviction stocks. Because the average 12-month return after a steep market decline, which is defined as a decline of at least 15% or more in the S&P 500's index value, is 55%. But this advice is easier said than done. We all know to buy low and sell high. However, when the market actually takes a hit, not many people are willing to average down. And this chart illustrates that. This is a chart of the US equity asset flows versus the S&P 500 returns chart. This blue line over here represents the 12-month S&P 500 return, and this dark blue graph represents the net asset flows. In the height of the Great Recession, where the S&P 500 declined by quite a fair bit, net asset flow was actually negative during this period, which means that there were more selling than buying. However, after the S&P 500 bottom over here, the recovery for the S&P 500 over here were significant. But can you see that during this time period, net asset flows continue to be negative, which means that even though the S&P 500 was making a very strong recovery and posting strong gains, there was still more selling than buying. And when finally net asset flows turns positive, this corresponds to a decline in the S&P 500 return over the same period. And over here during the 2017 and 2018 period, as the market reaches an all-time high, there were a record of net buying. And we know that subsequently after that, the S&P 500 took a hit. So what this chart shows us is that the best time to pick up stocks is when there is net selling in the stock market. So right now in midst of this panic, when most investors are worried about their stocks and are selling their stocks, this is actually the best time to buy stocks. So hopefully now that I've shared with you some numbers and figures behind the decline of the US stock market so far, you will have a better understanding of this stock market correction and be able to look past those sensationalized headlines and make a better and more informed decision when investing in the stock market. If you have learned something from this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this. And if you haven't already subscribed to this channel, make sure you subscribe to this channel because each week I release new videos about investing, trading and the stock market. I'll see you in those other videos. To your financial success.